Auditing Standard SA 265 Part 1. Auditing Standard 265 focuses on the auditor's responsibility to communicate deficiencies in internal control to those charged with governance and management. The standard applies when the auditor identifies such deficiencies during the audit of financial statements. Scope and objectives. The standard applies to the auditor's communication of deficiencies in internal control. The objective is to appropriately communicate identified deficiencies to those charged with governance and management. The auditor's responsibility is to communicate deficiencies that are of sufficient importance to merit attention. A deficiency refers to a control that cannot prevent, detect, or correct misstatements in the financial statements on a timely basis. A significant deficiency is a deficiency or a combination of deficiencies that, in the auditor's professional judgment, requires the attention of those charged with governance. The auditor must communicate significant deficiencies to those charged with governance and management. The standard applies to audits of financial statements for periods starting from April 1, 2010. The auditor may communicate other internal control matters identified during the audit, even if they are not significant. Requirements. The auditor must determine if any deficiencies in internal control have been identified based on the audit work performed. If deficiencies are found, the auditor must communicate them appropriately to the relevant parties. Discussions with management may be necessary to obtain additional information or address the identified issues. The auditor should engage with the appropriate level of management, considering their familiarity with the control area and authority to take remedial action. Smaller entities may have different control activities but may rely on management's oversight and decision-making for effective control. The auditor should consider these differences when evaluating internal control deficiencies in smaller entities. The auditor should balance the higher level of management oversight with the potential for management override of controls. Significant deficiencies in internal control. The auditor determines the significance of deficiencies based on the likelihood and potential magnitude of misstatements, not just the occurrence of misstatements. Factors considered include susceptibility to loss or fraud, complexity of determining estimated amounts, financial statement exposure, and the importance of controls to financial reporting. Indicators of significant deficiencies include ineffective control environment, absence of a risk assessment process, ineffective response to identified risks, and misstatements not prevented by internal control. Combined deficiencies affecting the same account balance, relevant assertion, or component of internal control may create a significant deficiency. Some jurisdictions may require auditors to communicate specific types of deficiencies in internal control using established terms and definitions. If no specific terms or definitions exist, the auditor should exercise judgment based on applicable standards. By following these auditing standards, auditors can ensure that deficiencies in internal control are appropriately communicated to those charged with governance and management, safeguarding the accuracy and reliability of financial statements. Thanks for watching.